This is Advisorpedia's Power Your Advice podcast, and I'm Doug Heikkinen. We're at Envestnet's Elevate Conference, and we're joined by Dana Diaria, a Group President and Co-Chief Investment Officer at Envestnet. How are you?
I'm great. Thank you for having me.
It's got to be Chief Investment Officer. Has to be an incredibly crazy time for you, the questions you're getting, and your brain.
Yeah, I think anybody in the investment field right now. But on the other side of it, how do you really trade against this anyway, right? I mean, what chief investment officer is out there saying, yep, I've got the magic formula. I know what you need to do. I mean, we're all kind of saying the same thing, right? Like, stay the course, take a deep breath, keep calm and carry on. I mean, I don't know anybody who's, really trying to time this market.
Right. So what should advisors be thinking?
Well, I mean, as a starter, be on the phone with the client, right? I mean, there's so many surveys that say, look, what they're looking for you from you now in a time like this is communication. They want to hear from you, So, I mean, I love that there's so many advisors here, and I really respect the fact that they took the time because that they're on the phone with the clients throughout the course of all this. And everybody's going to remember, I think, where they were when, had these big spikes, right? I mean, look at what happened Monday. You have a false report that there's going to be a reprieve on these tariffs. The market skyrockets. It turns out to be false. Market drops, right? And so I was on stage, Wednesday, and I was kind of showing a graph of this to talk to advisors about why, hey, look, there's no way you're going to time this. And literally, as I'm on stage doing this presentation, the advisors are in their seats getting, kind of the news, right, that there's going to be a reprieve. I was crazy. Like, what do you do around this? You communicate with your clients like crazy. You try to get them to stay, disciplined. Look, you also do want to make sure they're in the right kind of portfolio for volatile times. I mean, we're pretty clear from our perspective, be diversified. There's this sort of argument out there, hey, look, in bad times, correlations all go to 1, so how is diversification really helping me? But that's a very narrow view, right? In that moment, sure, everything looks bad because systematic risk is such a big part of the overall risk. But zoom out a little, like, okay, look at it from a standpoint of months, a year, a couple of years. That diversification matters. And you don't want to be concentrated in the worst place in volatile times. So stay diversified, be at the right risk tolerance, and then stay the course.
Have you ever seen something like this before?
Well, 2008, of course, 2008 was a rough period. In fact, I actually referenced it too, because one of the things we talk about a lot here are customized solutions. And one of the big ways you want to customize is tax, right? If you have somebody who's in like an SMA, for example, are you taking advantage of a time like this? I mean, there was no worse conversation I've heard, I think, in my career than clients in '08 who not only had their portfolios drop dramatically, but they had a tax bill, so those clients, right? It just so happened that what they were invested in, there were cap gains distributions that year. And they, it's unfathomable almost, right? How am I having this massive cap gain distribution when the portfolio lost all this money? But of course we know that's absolutely possible in a fund. So, I mean, I think advisors looking back, on kind of the experience of the past, '08's a good one. I mean, COVID's a good one. And kind of the lessons we took from that are applicable here.
So why tariffs? Why are tariffs causing such volatility? Give me a little bit of education on what they are and why they're rocking the boat so much.
Yeah, I mean, at the end of the day, it's a consumption tax, right? Like, at the end of the day, it's a tax put on this import, and it requires the consumer, whether it's the buyer who's then going to pass it on to the end consumer, to kind of pay this tax, and it has the specter of raising the cost. So we just got through, obviously, a period of pretty bad inflation, right? And it was kind of V-shaped, upside down V-shaped, right? Maximal increase, and then it came down pretty fast too. But everybody's very wary about inflation. So in the midst of that, to then put a bunch of taxes on imports that we all rely on, you're raising the specter of another big price increase. So that's very concerning. We came into this year with this expectation of a big bull market, that this administration was going to be really pro-growth, pro-business, and also that they cared a lot about inflation. And so I think everybody knew tariffs were coming. That was well signaled. But I think the breadth, the magnitude, that caught everybody off guard. And now you're saying, okay, now we got to rewrite this whole picture we had, and this could seriously hurt growth, right? And what that means, of course, is we could have a price increase at the same time we're wiping out a lot of the growth story. And then you're looking at potentially stagflation. You're looking at the Fed trying to figure out, do I cut rates to battle the encroaching recession that, would have unemployment, or do I keep rates where they are because I got to keep inflation at bay? So it's just, it's obviously very difficult for markets. And I think the other, one of the other points I would make that about this, the volatility, the uncertainty, the sentiment factor, is that, the precedent is that the executive branch can kind of set these tariffs at will. And that's what makes this a little bit crazy and nerve-wracking, right? In the morning, we could do one thing, and by the afternoon, we could get more news, and there's really no governor on it.
So if the message for investors is always stay the course, why the market swings? Because people want to be traders?
Yeah. I mean, look, the message is one thing, right? What people are doing is quite something else. I mean, not everybody has an advisor sort of providing some ballast in the relationship. I mean, the investing public and investments at large, a lot of people are paid a lot of money to try to figure out the right thing to do. And quote unquote, figure out the right thing to do can be very much a trading mentality, not a investor mentality. So very different messaging depending on what your engagement with capital markets really is. But for advisors, who are here at our conference, I mean, for the most part, the stay the course message is the right message.
And enter the Fed. So what's the Fed going to do?
Yeah, I know there's a difference in opinion about what the Fed thinks it's going to do and what the markets think the Fed's going to do. I mean, the markets certainly think, the Fed put is back on the table. We're going to get more rate cuts. They're going to have to accelerate. There's even some concern that maybe they're already behind the curve given the magnitude of what this could be. Now, notwithstanding, we've got this, sort of temporary reprieve. But I'm more in the camp, honestly, that I think this Fed has been slow to act. They've demonstrated that. And I think this one is going to be no different, right? I think they're going to take their time and look and see, are these tariffs destroying demand or are they raising prices? Because if they're raising prices, we're not excited about cutting.
Dana, you're very busy. It's been a great conference. I'm going to go let you answer more questions. Thanks so much for being with us.
Thank you.
To learn more about Envestnet, please visit Envestnet.com. Please follow us on LinkedIn, X, and Facebook, all at Advisorpedia. For Everyday Advisorpedia, our producer Tori Miller and the Power Your Advice podcast team, this is Doug Heikkinen.